Well, the summer has seen a big run for stocks like Nvidia, extending its gains over 30% in the last 3 months, surpassing its 200-day moving average. Joining us now to read the charts is Katie Stockton, Fairlead Strategies founder and managing partner and a CNBC contributor. Katie, always great to see you.
Good to see you, too.
Nvidia, what do you see here?
It actually looks like a short-term breakout within its very steep long-term uptrend. But I wouldn't be chasing it here. I do feel that there's been a loss of momentum more broadly for the tech space. That includes Nvidia. Our intermediate-term gauges are probably at best neutral right now. So we feel that we would hold existing long positions, but not adding exposure until we feel convinced that the corrective phase in the broader market is over.
Okay, and what will you need to see in order to be convinced? And I'm assuming you're talking about specifically the biggest tech stocks, the quote-unquote Magnificent Seven, as some like to call them.
Well, it's been really interesting. So the past 2 weeks, we've had some relief from the weakness in early August. And those 2 weeks have been very largely driven by those mega caps. And I think it shows the propensity of investors to go right back to the existing leadership of the market into weakness. So I do still think that those leaders will take us out of this corrective phase, but I'm not convinced it's over yet. We tend to see corrective phases unfold in like an A, B, C fashion, the B being a counter trend move. And I think that that's what we've probably seen over the last couple of weeks. And perhaps stabilization in yields instills the next downdraft.
You surprised by how quickly the market seemed to turn around in the month of August? As we were talking earlier, really a tale of 2 months.
Well, we did get to a place where it was a widespread short-term oversold reading, and it wasn't a very fast and furious pullback, but it was enough to generate that. So from sort of a breadth perspective, it actually was somewhat natural. And, of course, now we come into September, and there's very weak seasonal influences. So I think we need to assume that we're not out of the woods yet. But the damage really is only short-term at this point. So we still have long-term positive momentum. We still have breadth that is actually constructive, even though it's pulled back.
There were some who, I'm sorry, there were some who said that since we started with Nvidia, that the lack of reaction maybe marked a top in chips, generally speaking. But you just said that now we have another near-term breakout.
Well, it does look like one. It's not one that I'm chasing or buying into. We actually also have one in Alphabet that looks like a short-term breakout. But because of the top-down influences, that's why I wouldn't be adding into strength for these names. And then you see Broadcom under pressure this morning. I think semiconductor stocks do exhibit leadership in uptrends. But right now, I think we see one more downdraft before we get back into that sort of reassertion of the uptrend.
Where do you see rates going in this positive uptrend for stocks? Do they have to go lower?
It's really interesting because what we've noticed is that the direction of yields is almost less important as it pertains to market sentiment than the trajectory or sort of the velocity of the move. So when they're running up strongly, that tends to have a negative impact and vice versa. Right now, we're looking for stabilization above around 4%. It's about where the 50-day moving average lies for the 10-year. And after that, we're looking for more consolidation, sort of a grind sideways to lower, perhaps for a few weeks. And that might not influence sentiment in the way that it has done.
So the high that was established in October on the 10-year, that holds?
For now. So we ultimately think it will be broken because of that long-term upside momentum behind yields. But I don't think it'll happen in the near term.
Wait, you think it will be broken, though?
Eventually.
That yields are going to go higher? Because then obviously stocks are going to have a problem.
Yeah, well, and it's just a matter of when does that happen, right? The 434 level is the resistance. It's very, very widely followed. Above that, I do think that would be a drag on equities. There's no real resistance nearby beyond that level. Mm-hmm. So I do think that would certainly impact.
Why would it happen, though? I mean, what's going to push rates beyond that 434 level, right? If we think that the data is getting a little softer around the consumer for certain, and the Fed is, arguably done. Maybe they go one more time. What's going to be the catalyst to push rates up?
The charts won't answer that question, unfortunately. So as a technical strategist, I'm just looking at the trend and the momentum. So to me, the force is momentum, but what the driving force of that momentum is really more of a macro question.
What is the reaction when you talk to investors when you present this then? Because they're probably asking the same question.
Well, when I say 5.25 is the next resistance, there's a gasp. Yeah. And reasonably so, because it's very much higher than current levels. I don't think it's a near-term concern. But I do think that it kind of begs that the higher for longer argument is valid from a technical perspective. We've seen what we believe to be a secular shift in interest rates.
For crude, we've seen a big rise. This morning, we're watching it up by about 1.3% on WTI. What do you see for that in terms of the momentum into the back half of the year?
It's been interesting. Energy resurfaced in August as the best performing sector of the S&P 500, and that's brought its ratio versus the S&P up into its 200-day moving average. So it's at a proving ground in our work, and so is crude oil. Crude oil is right up against resistance. It's testing it right now at $83 per barrel area. A breakout above that would act as a positive catalyst likely for energy stocks, more so than what they have seen. And we do have indications of a basing phase also in natural gas prices.
There is an argument that that energy as a sector should recoup some of its percent loss as an S&P component. Are you a buyer of that it should go back towards historical norms?
I don't know if I agree that things need to mean revert in that way. But I feel like momentum is really the key that we want to watch. And when energy has momentum, which it did over the last couple of years, well, we want to be there. But when we look at energy right now from a longer term perspective, it really has shifted from 2021, 2022, and it looks less compelling to us. So I would say I'm less convinced that would happen.